Ratio analysis. Now, it's a deviation from all the managerial stuff that we have been talking about in the past few weeks, but it's still an important topic, and I think be very helpful to you. Even if you're never going to be an accountant, you can actually take some financial statements and analyze those financial statements and make some reasonable assumptions based on that. So ratio analysis gives you an open door to that opportunity. Now, what we want to think about, before we get into all the details that you see in front of you, what are we trying to accomplish? When I'm given a set of financial statements, or you're given a set of financial statements, and that includes the balance sheet, income statement, the statement of retained earnings or statements of equity, statement of cash flows, you need to be able to understand how to interpret what those numbers represent. What is this company telling me through their financial information and the disclosing notes to those financials? Because remember, the statements on their own should never be read. It should be read in conjunction with the notes. So the question is, what is it telling me? And how can I understand what's happening, the financial health of that organization? How can I compare it with other companies just like that one, regardless of size? And that's where ratio analysis is one of the tools that you can use to evaluate such company. Now, why we evaluate organizations and we use their financial statements and their notes to do that? Well, we may make investing decisions. We may make decisions based on whether or not we're going to lend them money. We may want to buy that organization, whatever. The bottom line is we want to look beyond the numbers and interpret their meaning. But we don't want to do it in isolation. We want to do it in a benchmark or a comparative analysis with other companies similar to that organization. How do we do it? The mechanics of it. And that's what I'm going to talk about today, the mechanics of it. Horizontal analysis, year by year. What happened last year compared to this year? And their variance in terms of percent and in terms of dollars. And again, the mechanics and all the computations is already discussed here. I want you to say what we're doing is we're checking year by year. And any kind of variances that we want to be able to examine. What happened? Why are we showing an overall decrease in our assets? Or why did our receivables get so low? Or what happened with our accounts payable? Why is it so high from year to year? And that gives us some information. So year to year trends, what's happening, what's good, what's bad, why, and what's going on, really. So horizontal analysis is one measurement. Vertical is going to be up and down, really. It's going to be up and down, meaning it's going to be the assets, in this case cash, in compared to total assets. It's going to be our accounts receivable in compared to total assets. And it's, again, that ratio between the assets and the individual asset items when compared with the total assets, if you want to look at it. So again, it's top-down approach. It's a top-down approach. Now, common size financial statements. Why would we want a common size financial statements? Because if you're taking Apple and comparing it with another organization that actually manufactures technology, type of handheld technology, you would look at their financial statements and say, my goodness, this is a $100 million organization, maybe even $1 billion organization, and this one is a little micro $100,000 company. How in the world can you compare companies that are just that big a difference in revenues? We make them common size. By making them common size, we're changing everything from dollars to percents. Percents are easier to measure, and they equate the two. They don't make them the same, but they make them measurable. Because again, if you look at $100 million in revenues and you're comparing 100,000 in revenues, you're going to immediately think that the big company is better and it's more financially sound, which in reality may not necessarily be the case. So vertical is going to be looking top-down approach from top to bottom, meaning assets to total assets, current assets to total assets, that sort of thing. Also, income statement, again, total income will mean the expenses, and the ratio between what our total revenue is to our expenses. So it's going to be looking at top to bottom versus side to side or year by year. And common size is really taking all their numbers and converting them to a ratio. In this case, a percent or a decimal. And a percent is a decimal, basically. So 0.50 is going to be 50%. 0.45 is going to be 45%. So you're making them in decimals or in percentages, so that you can compare companies that are very different in terms of their size. So that we make them common size and we equate them so they can be compared. Profitability. Now, again, now that we know we can do a common size, again, converting them into ratios, or in this case, decimals or percent, or we can do a horizontal, which is year by year. Now, let's talk about the ratios in particular. Now, when we're looking at financial statements and we are saying, oh, their company's doing fine, how do you know they're doing fine? Well, we want to measure their profitability. How do you measure their profitability? There are a number of various ratios or computations that you can compute to determine that. Profitability, gross profit margin, return on assets, return on equity, earnings per share. And again, no one in this course should be trying to memorize these ratios. What you should be getting from these ratios is what it is, and how it will be used. If I want to measure their debt level, I am not going to be looking at ratios like this. I'm going to be looking at different ratios. You get what I mean? If I'm trying to determine their turnover and their receivables, I am not going to be using profitability ratios to do that. That is what I'm trying to get you to understand here. Knowing what the ratios are and what information they provide the user is most important, and not necessarily how to compute, because you can easily get these ratio computations from online or in your textbook. It's more important that you understand what measurement that you need to use and how to use it and what it means. So profitability measures we are already given you. What about liquidity? What does liquidity mean? How much money, how much cash you have to meet your bills. And the current ratio is going to be how much cash you meet your current obligations. Quick means the quick assets, the more liquid the assets, how much of your very, very liquid assets that you can use to pay your current liabilities. Receivables, how fast you get your money back from your customers. When you provide services to your clients, how fast do you get your money? 30 days, 45 days, 60 days? Compare that to the industry average for that particular organization within. So if you're talking about a consulting business, how fast do other consulting businesses get their money? You know, because 30 days may be normal, 28 days may be better. So how do you know what's better, what's worse, and what things you need to address unless you compare that ratio with other organizations of similar background? The inventory turnover. Inventory is important. Why? Because some organizations have inventory and they use that inventory to generate revenue. So the faster they turn that revenue over, that means they're getting revenue, they're getting money, they're getting sales. So that's going to be healthy for an organization. A high turnover is going to be very, 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 very quick. I'm turning over 5, 6, 7, 8 times, 10, 12 times. My receivable number needs to be low. That means I'm getting my money faster than the average person. You see them? You see what I mean? So understand the ratio and what it means. Inventory turnover, you want it to be high because you want to be able to get that money quickly. You want to turn that inventory over to revenue. Receivables, on the other hand, you want a number to be low because the quicker you get your money, the more liquid you are, the higher your current ratio, the higher your quick ratio. That means you can pay your bills quickly, and people want to know that you are solvent. Solvency, again, debt to equity, debt to assets, times interest owed. Will that company be able to meet its obligations when due? Is that company going to be a viable entity in a going concern in the near term? And that's very, very important if you intend to lend that company some money or if you intend to invest in that organization. Balanced scorecard. Again, this to me, I interpret it as benchmarks. Using benchmarks to determine whether or not this organization is doing well and having a mechanism by which you can evaluate that. How well are we perceived by our customers? Can we improve that perception? Are we learning and growing? Are we getting better? Are we more efficient at what we're doing? All of that. Again, it's all about being a more efficient and a more profitable organization and having tools and measurements to do so. I really think this particular chapter might be fun because it has applicability beyond just being an accountant. You and I can use these for our own personal financial information, or if we want to invest in another organization, we can make some intelligent and informed practical decisions on whether to do so and why we are doing so. And again, as I always said, if you have any questions, by all means, reach out. And thank you very much for your opportunity, for time, for this. Thank you for listening. And if you have any questions, by all means, reach out to me. Thank you.